Welcome everyone, and thank you for joining us today. First I'd like to introduce the panel of experts that we have here today. Representing Boyes Turner, we have two partners, Matt Briggs on the private wealth side and Duncan Kay on the corporate side. I'm from Kirk Rice Accountants. We have Viru Patel and Richard Somerville, both of which are mixed tax partners working on the corporate and the individual private side as well. So we're going to jump straight into the conversation. So first of all, I just want to understand a little bit more as to what a FIC is and why are they gaining popularity, Duncan?
Yeah, so I'll take this one. Thanks, Sarah. So there is no specific legal definition as to what a family investment company is. It's purely a private company used to hold investments and other assets for a family. The same laws and taxes apply to a FIC as they would to a normal company, and it can be either registered as a private company limited by shares or an unlimited company. The way it's registered will have a bearing on what filing requirements it would have at Companies House, and we'll touch on this later on in the webinar. As to why they're gaining popularity, they're very useful vehicles for succession planning, and they're a great way of passing the benefit of wealth onto the next generation without relinquishing control from an elder generation. So they're highly flexible and can be tailored to meet each family's specific needs. So we'll talk about the governance documents, so the articles of associations and shareholders agreements, which can be tailored to whatever requirements a specific family has. They can take advantage of lower corporate tax rates on investments compared to personal tax rates, which we'll also touch upon, and they're simpler to run than a traditional trust. The other advantage that people find is that most high net worth individuals who would be looking up to set up such a structure are usually familiar with companies, and therefore they are comfortable with managing and running a business in a private company structure. So I think that answers what they are and why they're gaining popularity.
Brilliant. Thank you, Duncan. So next we're going to look at what the difference is between a FIC and a trust. And first of all, Matt's going to talk a little bit about the legal side of it before he hands over to Viru, who's going to talk about the tax implications.
Thanks, Sarah. Yes, let's start with governance. So this is where family investment companies, or FICs, clearly differ from traditional trusts. A FIC is a private company limited by shares, and it operates under company law. So that means that the levers of control are shareholdings and the articles of association, not trustee discretion. Directors owe statutory duties, and the company itself is a separate legal person. Decision-making in a FIC is highly customizable. So you can create multiple share classes and use shareholder agreements to tailor voting rights, dividend entitlements, and information rights. So, for example, founders can issue non-voting economic shares so that family members benefit financially without having control. The management also looks different. So a FIC is run by directors. Who can be family members or independent professionals within a board governance model. So that means formal minutes, statutory accounts, and filings. FICs operate under company law with those formal governance rules, statutory duties, and documented decision-making processes. So for families who want clear records and accountability, a FIC can therefore be a real advantage. Governance can be more formal and auditable than with a trust, where decisions might be at the discretion of the trustees. Now let's move to succession. So how wealth and control pass between generations. In a family investment company, succession is usually achieved by transferring or making a gift of shares, or by relying on pre-agreed buy and sell mechanisms that are written into the shareholder agreement. This tends to be simpler and also more controlled than reorganizing trust interests, which often requires trustee action and can be administratively complex. Another key advantage is continuity. A company benefits from perpetual succession, so it continues seamlessly regardless of individual deaths. there's no need to reappoint trustees. And that stability can help minimize disruption to the family's investment strategy and the day-to-day operations. Flexibility also comes from those share classes. So founders can issue growth shares to younger generations, allowing them to participate economically whilst retaining voting shares themselves to keep the control. So this staged transfer of wealth and influence can be more difficult to replicate in a trust structure. Exit and liquidity planning can be built into the company's articles and the shareholder agreements. So provisions such as drag along and tag along rights, buyout formulas, and valuation mechanisms help manage disputes and exits. And by setting those rules in advance, families reduce the risk of forced asset sales when succession occurs. And those mechanisms can help reduce uncertainty and disputes when ownership passes from one generation to the next, and offers family then a clear corporate framework for passing on wealth. What I've discussed is very much looking at FICs and trusts as separate structures, but I just wanted to mention that in practice, families often combine the two of them in a hybrid approach. So a trust can be used to hold shares in a family investment company, and that means that the FIC provides the corporate governance, the succession mechanics, and the tax planning opportunities that we're discussing here today, while the trust adds an extra layer of protection and flexibility. So, for example, parents might settle voting shares into a trust, with trustees overseeing how those rights are exercised. At the same time, economic shares can be issued directly to family members, and that way the trust safeguards control while the FIC manages investments and succession in that structured, transparent way. So the trust can add the protective and discretionary features, whilst the FIC is supplying structure, accountability, and succession planning. And together they deliver that balanced solution that combines the strength of both models. What we're going to do now is comment on the tax considerations, and these are complex issues that require specialist advice. And on that note, I will pass you over to Viru, who's going to highlight the key inheritance tax and capital gains tax differences between FICs and trusts.
Thanks, Matt. Yeah, there are significant differences on the tax implications of a trust and a FIC, and I'll outline some of the key ones. For inheritance tax purposes, the amounts that can be transferred into a trust are limited to the nil rate band, which is currently 325,000, and for a couple, it's 650,000, in order to avoid any immediate inheritance tax liability. Whereas transfers into a FIC are unlimited. Furthermore, the person setting up the trust may be able to control the funds, but cannot benefit from them. Otherwise, the gift will fail for inheritance tax purposes. It will still be in their estate on death. Whereas in a FIC, the founder can retain control and also receive some of the benefits by extracting the profits. For capital gains tax purposes, assets transferred into a trust are treated as disposals at market value by the person setting up the trust. However, usually the gains can be deferred until the sale of the assets, but as mentioned before, the transfer is limited to the nil rate bands or bands. Transfer as assets into a FIC will again be treated as a disposal at market value with usually no reliefs. However, there will be a credit to the director's loan account with the FIC, which can be drawn from the profits tax-free. A FIC is subject to corporation tax on its income and gains, up to a maximum rate of 25%, whereas trusts with trustee discretion are usually subject to higher rates of tax on income and gains. Families can extract the profits from the FIC by way of a dividend or salary, whichever is most tax efficient. In a trust, distributions can be made to beneficiaries either as income or capital. And again, these will be subject to income tax and possibly inheritance tax as well. As Matt says, it's imperative that professional advice is sought at the earliest, as these are complex arrangements and have to be structured carefully and efficiently. Thank you.
Okay, so I think this leads us to the question of who typically sets up an FIC. Would you be able to answer that for us, Richard, please?
Yes, I can. Thanks, Sarah. Well, as I think both Matt and Duncan have alluded to earlier on, there's nothing special about a FIC. It is just a standard company. So anyone can actually set a FIC up and run it. It's usually motivated by a decision to pass wealth and assets in a sort of tax efficient wrapper. So typically anyone can set a FIC up. There's nothing special. Usually you find it's high net worth individuals that create them, or business owners, or maybe entrepreneurs who are looking for just some investment platform for them and their family. Another typical type of client you usually see is people holding substantial property portfolios and deciding that it's possibly, let's explore some of the tax relief which a FIC can offer them, which holding them individually, there are certain things that are quite different between the two. And another particular type of one is when you want to manage and grow family wealth, but actually retain control. So usually the founder will have some level of control over the family wealth, which he's looking to pass down a generation. So all in all, I think anyone can set a FIC up, and they're quite convenient for many reasons.
Thank you, Richard. So is a FIC suitable for every family, Matt?
Well, so touching on what Richard's just said, a family investment company can be a powerful tool for managing family wealth. It tends to work best for families with significant investable assets, clear succession goals, and a willingness to adopt corporate governance and compliance obligations. So in those circumstances, a FIC can centralize investment management, provides a clear governance framework, and align long-term family objectives. I mean, that all said, a FIC is not a one-size-fits-all solution at all. So for smaller estates, the administrative, legal, accounting costs of running a company can outweigh the benefits. So setting up and maintaining a company does require ongoing compliance. It does require filings and professional input. So for families with limited assets, those costs can erode the value a FIC is intended to protect. In those cases, a simpler trust structure can deliver better net outcomes. And if the objective is a straightforward low-cost transfer of a small portfolio or a one-off gift, then a FIC is often over-engineered. So trusts or direct gifts can be a simpler, faster, and cheaper method of implementation. And whilst FICs offer structure and some protection, they're not the only option. So trusts can provide different protective and confidentiality features that may suit families who have strong privacy or protection priorities. In practice, as I mentioned earlier, they can be used alongside FICs in a hybrid approach to maximize the advantages of both. And families who have cross-border members or unusual tax profiles, they may face uncertain tax outcomes with a FIC unless specialist advice is obtained. So tax rules, residency tests, and reporting obligations, they can all materially affect the benefit of a company structure. So when tax or residency is complex, tailored advice is essential, really, before committing to a FIC. So although a FIC can be powerful for the right family, it isn't universally appropriate. So suitability will depend on wealth level, governance appetite, tax position, long-term objectives, a cost-benefit analysis, a clear mapping of family goals, and specialist tax and legal advice should all be part of that decision-making process.
Excellent. That's really interesting. Thank you very much, Matt. So on to Viru now. So what types of assets can you usually hold within a FIC, please?
Sarah, any type of assets can be held in a FIC, but typically, in my experience, these will be cash, a property portfolio, or investment portfolio. The most beneficial would be cash because transferring into FIC will not have any tax implications. Property portfolios, you will have potentially capital gains and probably stamp duty land tax implications. Investment portfolio, you'll have capital gains tax implications.
Okay, thank you. So how should a FIC be financed? I think I'm going to give this one to Richard and Duncan.
Do you want to start with the legal aspects, Duncan, about the actual drafting of appropriate legal
Yeah, I think
advice?
just to reiterate the point that Matt and Viru and everyone's made so far, the key thing when financing a FIC is to seek appropriate tax and legal professional advice to ensure that the documents are properly prepared and do what they should be doing. There's obviously risks with getting this wrong. So, as with any of these kind of tax administrative strategies or structures, it's best to take advice before entering into the documentation.
Yeah. I mean, I think it's fair to say that generally that there's usually a director or a founder's loan going into the actual company to start financing it. And then there's usually or typically follows a subscription of shares. Now, and again, I think alluding to what you've just said, this should be carefully drafted just to make sure we don't fall foul of any tax anti-avoidance rules. But usually when there's an asset transferred, it would usually create a credit to a director's current account, which can then be drawn down the line when profits are available to be distributed tax-free for the director. So it's a kind of way of passing money or an asset on to his family, but actually being able to draw out the future profits tax-free until such times that loan is repaid. Another way would be just often parents or founders will, once they've transferred assets or cash, they'll invite their children to subscribe for growth shares. When at this point in time, because the business has just started, usually the value of those shares will be fairly low. So it's quite beneficial from a tax point of view to sort of take these decision-making choices at the very beginning when you're setting one up. And possibly last would be just an outright direct subscription for shares, which you and your family members may wish to do. So they're fairly flexible in the way you can finance them overall.
Thank you, Richard. So
just to add to that,
sorry,
just
Duncan.
say that depending on what the asset being transferred into the FIC is, there may be specific legal requirements to be aware of. So around property or something like that, which you would need to be looked at by a competent legal professional as well. Brilliant,
thank you. So, Viru, what are the tax implications of transferring assets into the FIC?
This would be basically cap gains on the asset based on the market value. In some cases, the gains arising on transferring a property portfolio to a FIC may be deferred. The capital gains tax would be at 18% for property transfers for basic rate taxpayers and 24% for our rate taxpayers. Stamp duty land tax, if land or property is transferred into a FIC, again at market value. The stamp duty land tax would be at a higher rate because it's being bought by a company if it's residential property. But if 6 or more properties are transferred, then the tax would be at the commercial rate. There's also what we call annual tax on development dwellings if residential property is transferred. But if that property is commercially let, then you can claim relief. Otherwise, there'll be a tax charge. There is no uplift on the base cost on death if property transferred into a FIC. However, there will be an uplift on the share value on death. The corporation tax on profits or rental income will be a cost to the but you can repay the loans from retained profits. So on retained profits, you can either pay the dividends or salary or make repayments of the loans to the founders.
Thank you, Viru. So I think a key question for me, Matt, is how does a FIC help with the estate planning?
Yeah, no, absolutely, Sarah. Thank you. So well, at its core, a FIC converts family wealth into share capital. Assets are no longer held directly by individuals. They sit within a company structure. And that shift creates a framework for clearer governance, staged succession, and also potentially inheritance tax planning opportunities. But it's important to emphasize, as we have done throughout here, that the effectiveness of a FIC depends on careful design and professional tax advice. So just sort of breaking down those elements, how does a FIC, when you're looking at estate planning, change ownership and control? So first, ownership. So founders transfer assets into the company in exchange for shares or loans. Wealth's now held by the company and not by the individuals. Second, control versus benefit. So by creating different share classes, founders can retain voting rights while younger generations receive economic shares. And then decision making can stay with the founder while value is gradually passed on. Third, governance. So because a FIC operates under company law, as I mentioned before, it requires directors and board minutes and statutory filings. And that formal structure ensures decisions are made in a consistent, auditable way. Drilling back into the succession mechanics, succession is managed through share transfers. So shares can be given away or sold or transferred under pre-agreed provisions like buy and sell or drag along and tag along clauses. And that makes succession predictable and enforceable. And again, touching on earlier conversation, the company itself is perpetual, so it continues regardless of individual deaths. That continuity avoids the disruption of trustee reappointments. And importantly, it can help succession can be staged. So founders can design gradual transfers using growth shares or vesting rules. So family members gain economic exposure over time rather than an immediate shift in control. From a tax perspective, transferring shares can remove future growth from a founder's estate, but the impact does depend on valuation, retained rights, and timing. So professional modelling is essential. Families can also extract value through dividends, salaries, or share sales, each with different tax implications compared to trusts. And as a word of caution, a FIC isn't a universal shield, so it doesn't automatically eliminate inheritance tax or creditor exposure. Outcomes depend heavily on the structure and on the behaviour. For example, whether founders retain too much control or lend money back into the company. But in terms of practical steps for estate planning with a family investment company, first of all, design share classes carefully, separate voting, income, and capital rights to match objectives. Secondly, document governance and succession rules clearly with dividend policies and buy and sell triggers and dispute resolution mechanisms written into the articles and the shareholder agreements. Thirdly, run tax projections before implementation. So model the inheritance tax and capital gains tax and income tax position under different scenarios. And finally, use professional advisors. So legal, tax, corporate input is essential to ensure compliance, accurate valuations, and defensible tax positions. So, a family investment company can be a really great estate planning tool. It offers that formal governance, that controlled succession, the potential tax advantages, but it must be carefully structured, costed, and supported by professional advice to deliver those intended outcomes.
Thank you, Matt. So, Duncan, how should a FIC be structured, balance control and succession?
Yeah, so I think the question is really just reiterating what Matt just went through. So as a FIC is a normal private company, it's going to be governed by its constitutional documents, being the Articles of Association and the Shareholders Agreement. And effectively, these can be tailored to meet each family's specific requirements. So it really depends on what the makeup of the family and generations and different branches are and what their objectives are. So it's a very flexible mechanism or tool to use. And it's one which will allow elder generations to maintain control of the distribution of proceeds of assets, but pass the benefit of the economic benefit to the younger generations. So when thinking about that, as Matt's already said, the key things to really plan ahead are the different share rights, so as to voting, receipt of dividends, information rights, and preemption provisions on transfer of shares, how they can be transmitted and to who. So all these kind of things need to be thought of ahead of time and carefully plotted, because as you can imagine, with a large family, there'll be different generations which have different needs, and again, different branches of a family who may also have different circumstances, and also how each of those then want to control the assets within the FIC, which needs to be thought about and can be dealt with by different branches having different rights to appoint directors to the FIC who have day-to-day control of the business, different branches or generations having different voting rights as to the shares, having restrictions on who shares can be transferred to. So on that point, one of the things which we see quite often is restrictions on shares being transferred out of the line of lineal descendants. So having restrictions on only shares being it being possible to transfer, or shares to be held by lineal descendants of the main family bloodline. So as well as all those considerations, you can also bring in other tax efficient tools such as freezer shares or growth shares, and that will allow different generations to crystallize their position or offer growth to younger generations. It's also important to think about the different filing requirements for private limited and unlimited companies, which I touched on at the start. So where a FIC is a private limited company, it will have to make certain filings at Companies House, which are publicly available. And these will include the annual accounts, the company's articles of association. So you should think about which provisions you want publicly available, or which should be kept in the shareholders agreement, which is a private document, and details of the persons with significant control. So an unlimited company, on the other hand, is subject to various exceptions and does not necessarily have to file all of those documents, especially around accounts and things. So it's worth considering which you would prefer.
Thank you. Thanks, Duncan. So how does a FIC enable learning and responsibility, Matt?
I think this is an often overlooked benefit of family investment companies. So beyond being a vehicle for wealth, a FIC can become a structured environment for teaching responsibility, financial education, leadership to the next generation. So instead of handing over lump sum gifts, families can use the corporate framework to gradually introduce younger members to decision making and oversight. And the FIC can create real roles with real accountability. So family members can hold different classes of shares. They can sit on boards or committees. They can take responsibility for investment decisions, reporting, and risk management. Parents can also design staged authority. So voting rights or share vesting can be conditional so that responsibility grows with competence. And that's to help encourage long-term thinking and accountability. And importantly, FICs provide decision frameworks. Governance documents such as board charters or investment policies teach the next generation how to make decisions within constraints, document their rationale, and accept consequences. And those are all skills that transfer well beyond finance. And because, FIC holds real assets, it becomes a living classroom, if you like. So younger members can learn budgeting, portfolio analysis, asset allocation, and performance measurement in practice, not just in theory. Families can help set up structured learning pathways, junior boards, investment committees, mentorship pairings. And that way, younger family members learn by doing and by shadowing more experienced directors. External training can also be integrated with practice. So courses in finance, corporate governance, or ESG can be tied directly to responsibilities inside the FIC, with measurable tasks and KPIs reinforcing the learning. Serving on committees or leading projects within a FIC exposes young people to leadership under pressure, stakeholder management, negotiation, even public speaking. And these are experiences that can help to accelerate maturity and resilience. Families can embed values and purpose into the FIC through philanthropy, ESG criteria, or mission-driven investing. And this helps heirs align wealth with their personal values and develop a sense of legacy, as well as fostering entrepreneurial practice. So a family investment company can therefore be far more than a financial tool. When intentionally designed, it does become that structured environment that teaches responsibility and delivers practical education and accelerates personal growth. It's a platform for preparing the next generation, not just for wealth, but for stewardship.
Brilliant. Thank you for that. So I think we've answered all of the questions that we were looking to answer. Is there anything anyone else, before I move on to any questions, any of the panel want to say that we've missed? No? Okay,
No.
great. So thank you very much to the panel. I think that's been really informative. I've got a couple of questions myself to ask. I know we've got someone else who's asked a question. If anyone else had any more questions to ask, then please do pop it into the questions box at the bottom. So last week we had the budget. So how should families reassess FICs? And are there any immediate tax and structural actions that should be important? So who wants to jump in and take this question?
I'm happy to. Yes, the budget raised dividend rates, which directly increases the cost of taking money out of a company's dividends and narrows the tax gap between FIC distributions and other routes of extraction. So where dividends are now more costly, you could consider short-term alternatives like one-off capital distributions, documented loans, or salary adjustments, but only after modelling the capital gains tax consequences and any national insurance contributions. So I'd suggest families, they can remodel their extraction strategies, review their share classes, test any planned share gifts against the tax landscape. And tax, as we know, does change. There's always something to keep under review. On the governance side, it's important to update family governance plans to explain why extraction timing or share transfers might change, and avoid rushed, poorly documented actions. So that's my take, but the rest of the panel might have another view.
I think I'd just add that the additional tax on dividends affects people whether they hold it within a FIC or outside anyway. So it is just a tax cost which we're all going to face in one form or another. And typically with FICs, especially with property portfolios, it's usually longer term growth lots of people are looking for. So I think it doesn't change much about the budget, hasn't changed much about the purposes and use of a FIC, I would say.
Great, thank you, Richard. Right, I've got a few questions in the question box. So what minimum size investment should be considered if you're thinking about a FIC? Sorry. Who would like to take that one?
Well, I used to be £2 million was the sort of starting mark. I'd say now, when you factor in all the things you talked about the ongoing compliance and running the structure, it might creep more like towards five. But I still think 2 is a really sensible starting point. It really depends on the family's objectives. What are they looking to get out of this FIC? What are the long-term objectives? A FIC to one family looks different to a FIC for another family. So it's really getting under the bonnet of what the objectives are. But I think 2 million probably sounds like still a very sensible starting point for a conversation around having a FIC as opposed to another type of vehicle. That's commonly what it's between the £2 and £5 million plus mark. And I think it's probably a very similar thing for you, Viru and Richard too, in terms of that value.
Yeah, I think so. And also I think, it doesn't have to be cash. It can be assets. As I said before, in my experience, it's been a property portfolio that you transfer into a FIC, but they do have initial tax upfront, cost, which which you have to consider if you want to go down that route.
Okay, hopefully that answers the question. So the next question I have is, can I hold my shares in a FIC inside a discretionary trust and still receive salary from the FIC, or is this a GROB?
They can hold shares in a FIC. I would suggest, to get dividends rather than salary. But there's always a risk that if you're controlling a company that you've actually made a loan to, which then is where the children subscribe for shares, then there is a risk that it could be treated as a gift with reservation. So that's why I think it's why you have to carefully draft the articles and shareholder agreements regarding the rights on the different classes of shares. So obviously you'd have different classes of shares, so it doesn't have this sort of impact.
Okay, great. So that one sounds like it might be a bit more of a complex question. So if the person who requested that one, if they'd like to get in touch, then I'm sure Viru would be happy to talk further about that. The next question: if you transferred a business along with other assets into a FIC, would it automatically lead to an HMRC investigation?
No. If you're transferring a business, I think we're talking about a property portfolio business here.
Yeah, I was going to say you need to define what the business is, but I don't think it automatically follows that you're going to lead to HMRC inquiry. The inquiries are about specific things usually, or there are particular characteristics, behaviours which lead to inquiries. A commercial transaction such as this shouldn't lead any more to an inquiry than a normal business transaction, which is outside of a FIC, but a normal company acquiring another company. It shouldn't really impact the nature of it.
Yeah, I mean, on the property portfolio, I mean, with as I said, there's capital gains and stamp duty, land tax implications. So I have seen instances where the property portfolio has been put into a partnership and then incorporated, and the incorporation relief or capital gains tax relief, that may well be okay, but putting into a partnership and then transferring it into a limited company, HMRC are now attacking that because they're suggesting that stamp duty, land tax avoidance. Because when you transfer a business from a partnership to a property portfolio partnership to a limited company, there is no SDLT from because of the calculation of the SDLT.
Yeah. And we are talking a formal partnership here, aren't we, Viru? We're not talking an informal 50-50.
Yeah, we're not talking about joint ownership. We're talking about
joint ownership. Yeah.
Okay, so I've got another question in that area, a little bit more perhaps detailed. If I wanted to transfer a portfolio of buy-to-let residential properties owned personally, what are the tax implications for that?
Okay, let me answer that one. Each property in the portfolio will be treated as being sold at market value.
Yeah.
And therefore, any capital gains tax arising will have to be payable, unless the property portfolio is such that you're managing it, the significant management time. It's essentially treated as a property portfolio business. There was a case, I won't go into it, but basically, if you're managing the property portfolio significantly, then you can hold over the gain into the shares of the FIC. There will be stamp duty land tax on the residential property, as I said, at the higher rate, unless you're transferring 6 or more properties, and then we can use the commercial stamp duty land tax rate. Properties in a company are liable to annual tax on enveloped dwellings, unless they're commercially let. And these are, if any of the properties are over 500,000. So ATED kicks in if any of the properties are valued at more than are bought at more than 500,000. Additionally, if the properties are not commercially let, then the additional stamp duty land tax of 17% on properties above 500,000.
Okay, fantastic. Thank you. I think that concludes all of the questions that we have been asked. So if there's nothing else that the panel want to comment at all, anything they feel that we've missed, then is there anything?
No, I don't think so.
Okay, brilliant. So just to say thank you now for joining us for this. Now, it's quite a complex topic. I'm sure you still have some questions on that. So if you do, we'd be really happy either on the legal side or on the tax implications side for you to get in touch. We've put some contact details on the screen currently, both for Boyes Turner and for myself at Kirk Rice. We will follow up after this with an email which will include a key guide about FIX, so some of the other questions, but more clarification of all the things that we've covered off in the call today will also be within there. So hopefully that gives you all the information that you need to help you to start thinking about this topic. So thank you very much, and hopefully we'll hear from you again.
Thank you all.
Thank you.
Thank you.
Thank you all. Thanks, Sarah.
So,